tuning into this update. I'm Joshua Dobi. Appreciate so much you taking a few minutes of your time here to hear a few words from us as we, ready or not, already through the first quarter of this year, into the second quarter. We're almost at the third of the way through the calendar year, and it's racing by. So I wanted to take a few minutes to talk about the first quarter a little bit, and also what we see currently and what we're continuing to expect here for the balance of the year. The first quarter, as measured by our most popular stock indices, very impressive. S&P 500 index hit double digits. It was positive 10% in the first quarter of this past quarter, and putting that on top of significant double-digit returns there in 2023, it's been a pretty formidable 15 months, especially as measured again by the S&P 500 index. Now, you've heard me talk about the index in terms of how it's comprised and how it's computed. Remember, the S&P 500 index is a market cap weighted index, meaning that the largest companies have the largest influence relative to the performance of it. Those largest companies, almost exclusively right now, are large cap technology companies. So for the S&P 500 index, even though you do own shares of 500 different companies, the index, in my opinion, is being swayed unnaturally by the movements of these exceptionally large companies, which all happen to be large technology companies. I'm looking at Apple, I'm looking at Amazon, I'm looking at Meta, Alphabet, the former Google, those kinds of companies which are having outweighed influence on the index. So when we see that the index is performing well, specifically the S&P 500 index, at this point it really means big technology companies are doing well at this point. Now, we had a good first quarter. Coming into the second quarter, things have been a little bit rougher here in the couple of weeks as we've started the second quarter. We talked about this in some previous updates that we expected, especially after the year that we had last year in 2023, for us to have some level of pullback at some point. We're about 5 to 8%. Some other stocks are in the double digits in terms of pullback off of their highs. Looking at technology companies, they have had actually more of a pullback, as we would expect in this kind of space since the end of the first quarter, especially in any kind of pullback scenario. Sidebar, generally speaking, the more aggressive companies, especially if they have led the way in a most recent surge, also tend to lead the way on the downside in the short run, and that's what we're seeing here in the second quarter. So pretty interesting to see. Don't know if this is going to continue, but this is needed and healthy, in our opinion. We need to have some breathing room. We need to have some pullback. I mean, some companies that are out there, I'm looking at Meta, I'm looking at NVIDIA. If you happen to follow the big semiconductor company, they have been up 30, 40, 50, even 60% and more just since January 1st. There's no company that's built to grow that fast for any sustainable period of time. So it's very natural that we would see a pullback in the short run, and that's definitely what we've seen here in the last couple of weeks. Now, also what has played into that, in our opinion, is what the Federal Reserve has, let's say, come around more to reality, in our opinion, here over the last several weeks. Towards the end of last year in 2023, the futures market, primarily fueled by what was being said by the Federal Reserve, indicated we would have as many as 7 interest rate cuts in 2024. Well, when we saw that, we shared that with you, that seemed to be almost fantasyland way of thinking about things, especially coming off of a streak of several rate hikes over the course of a year and a half that were the fastest and greatest in terms of volume that we've ever seen in our history. So to anticipate that inside of 12 months that was going to pull back again in those ways, we thought was unnatural at best. And that's what we're starting to see. So we went from pricing 7 rate cuts to then the futures market started to price 3 rate cuts. And now we're at about a break even for the balance of this year, meaning that relative to the futures market and certainly the rhetoric that is coming from the Federal Reserve, it would be possible that we would have 0 rate cuts this year. We actually believe at North Main Financial that's a good thing. We actually need some time to be able to absorb, to be able to experience what all of the rate increases mean for an economy of our size, in our opinion, before we actually get into a space of rate cuts. Now, that being said, there's no secret that the equities markets, the stock markets, definitely desire for a rate cut. Rate cut in their world means cheaper cost of capital, greater possibility to spend, cheaper access to all kinds of things in the financial markets, whether you're talking about loans, lines of credit, all those kinds of things. So that is perceived as a positive, and we would generally be in agreement with that. But there also, perhaps counterintuitively, there also needs to be a healthy interest rate in our markets in order for us to function properly over the long term. We got lulled to sleep over the last decade and a half by thinking that these abnormally low interest rates, i.e. in the 0% range to 3% range when it comes to mortgages, lines of credit, and the like, were actually normal. That's not true. I mean, wait until I tell you that the average mortgage rate over the last 40 years is about 7%. That's the average, meaning half of that time we've been above that amount. So when we look at that kind of thing in the context of history, we're actually approaching more a space of normality than we are of getting to a space of extreme. And that's why we don't have concern about rates rising and staying in this space for some extended future. As a matter of fact, we would actually prefer that it would be that way so that we can have a healthier, more balanced economic stretch with where we are right now. We'll wait and see. Anything's possible. We're not even pricing in an unexpected geopolitical event, so anything could happen in that space. And so we're going to continue to watch that very closely. But in terms of what that means for the equities markets for the balance of this year, that may mean that it's not going to be as rosy as perhaps was anticipated at the front end of the year when so many cuts were built into the mix. So we're watching that closely. Again, we would be very comfortable with the equities markets being in a space where it would be a very modest year of returns, especially coming off a very above average year of returns in 2023. So with interest rates staying where they are right now, very conceivable. We get that question a lot at the office from many of you and from other folks as well about where we expect interest rates to be. They may come down a little bit. We may get a cut here before the end of the year, but we also may not, so they may come down lightly. But certainly the secondary markets where those things are traded with regularity every day don't seem to indicate that at this point. So again, we'll watch that and bring that to you as things develop. But overall, again, we expect modest returns for the balance of the year this year. Always, we think that's a healthy way of coming at it. We don't want to get ahead of ourselves, especially getting into straight line thinking, where because things have done well in the past, they're necessarily going to immediately do well in the future. Things are cyclical, especially when it comes to equity and bond markets, and so we want to keep that in mind when we're thinking about our expectations going forward. Well, friends, I appreciate so much you taking the time to listen to me here and to hear our thoughts about where we see things right now. But always, 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 you know this, if you'd like to reach out to us, chat about your portfolio, if you want to take a look at tweaks, it's a different environment now. We actually have fixed income instruments that are paying 4 and 5% a year. Boy, haven't been able to talk about that for about a decade and a half. So it is a different environment, and it's certainly, it's not new. It's just we haven't been here for a long time. And be happy to chat about that with you with regards to your portfolio or anything else for that matter. If you're a baseball fan, we're getting into high gear at this point. For my Pittsburgh Pirates fans, boy, did we come out of the gate smoking. It was great to see. Now we've moderated a little bit. I get it, maybe a little sense of reality, but still playing perhaps above expectations, and that's always fun. Well, friends, again, I appreciate so much your time here. Always, always, always feel free to reach out to us with your thoughts and questions at any time. And until that next time, I'll look forward to chatting with you soon.